A massive 51% infrastructure segment revenue growth is quietly saving IBM from a severe liquidity squeeze. But does this spectacular cash flow mask a high-wire balancing act that most analysts are completely ignoring? Looking at the $10.47 billion in business acquisitions deployed in a single quarter, you realize IBM is playing an incredibly aggressive game. Headlines scream about their massive push into artificial intelligence, but the real engine funding this pivot is heavy physical infrastructure, specifically massive enterprise data centers. The hardware segment delivered a staggering 51% infrastructure segment revenue growth through IBM Xerox systems. Wall Street assumes legacy hardware is a dying business being cannibalized by cloud computing platforms. But today, these physical mainframes are essential for clients deploying secure, local artificial intelligence models. However, this hardware boom creates a stark contrast with the consulting segment revenue growth of just 4%. This sluggish consulting growth tells us clients are eagerly buying tangible computing power, but pulling back on expensive advisory services. For your portfolio, relying on overall corporate revenue of $15.92 billion is dangerous. The underlying segments tell two very different stories about corporate budgets, which is a vital lesson in value investing. To grasp why this hardware success is critical, we must look at something seemingly unrelated. The operating cash flow came in at a massive $5.17 billion. Casual observers are purely focused on headline profitability, pointing out the modest $1.22 billion in GAAP net income. GAAP net income is the accounting profit left over after all theoretical expenses are deducted. At first glance, a low accounting profit looks like a struggling legacy business. But the underlying reality is stronger because IBM boasts an elite 4.2 times cash conversion multiple. This means for every dollar of reported profit, the company actually generated over $4 of real spendable cash. This massive discrepancy is driven by non-cash amortization from software acquisitions and highly efficient working capital management. What does this actually mean for your investing strategy? It reveals IBM is significantly healthier than their 7.6% GAAP net margin suggests. You always want to value a company based on the actual cash it puts in the bank. This is a foundational principle of stock market analysis. This brings us to the elephant in the room regarding how that cash is spent. IBM distributed $1.58 billion in total dividends paid to shareholders this quarter. The consensus view is that this 31-year streak of dividend increases makes the stock the ultimate safe haven. The board even raised the upcoming payout to a $1.69 dividend per share. But here is the fundamental reality. That payout creates a 129.6% GAAP dividend payout ratio. The dividend payout ratio measures the percentage of earnings paid out to shareholders. IBM is technically paying out more in dividends than its $1.22 billion in accounting profits. While elite cash flow currently covers the check, this dynamic slowly erodes retained earnings. The golden rule in stock market analysis is to always check if a dividend is covered by actual earnings, not just trailing cash flow. If IBM experiences any hiccup collecting payments from clients, this sacred pillar of investor trust could be severely tested. This pressure to generate cash becomes obvious when we examine the balance sheet. Total debt stands at a staggering $66.36 billion. The broader market is captivated by the artificial intelligence boom and seems willing to overlook rising leverage. Right now, IBM is operating with a 0.80 times current ratio. The current ratio compares a company's liquid assets to the debts it must pay within 1 year. This means their short-term liabilities exceed their current liquid assets by over $8 billion. Within that liability pile sits $8.66 billion in short-term debt that must be managed soon. While a 0.80 times current ratio is common for enterprise software companies due to deferred revenue, pairing it with high short-term debt leaves zero room for execution errors. IBM is effectively walking a leveraged tightrope to fund their inorganic growth strategy. For your portfolio, this teaches us a vital lesson in fundamental analysis. Even cash-rich technology giants can run tight on working capital when they aggressively buy their way into new markets. Yet, despite this tight liquidity, management is doubling down on the future. Management released an aggressive $1 billion free cash flow growth guidance for next year. Free cash flow is the cash left after a company pays for operating expenses and $384 million in capital expenditures. Retail investors often assume management is inflating the stock price with optimistic projections. But this bold free cash flow guidance serves as a psychological flaw for the market and anchors institutional valuation models. IBM is essentially promising that their massive investments will yield immediate cash returns. If global enterprise spending slows down, missing this $1 billion target could trigger a severe market re-rating. This is exactly why you must track forward guidance just as closely as historical performance. The market always prices in the promise of tomorrow, not the reality of yesterday. Incorporating this foresight is a crucial element of any robust investing strategy. We see this pricing leverage because the GAAP gross margin hit 56.2% this quarter. That represents a 100 basis points gross margin expansion compared to the prior year. Gross margin is the revenue left after subtracting the direct costs of producing goods. Commentators often miss the importance of margin expansion, focusing instead on top-line sales. Achieving this margin growth while pushing through an 11.4% R&D spending growth rate proves something vital. It proves IBM possesses formidable pricing power in the enterprise space. They charge premium rates to deploy complex software across hybrid environments, and clients willingly pay it. The golden rule here is that when a company raises research and development costs by 11.4% while expanding profit margins, it has a defensible economic moat. Recognizing this moat is a key tenet of value investing. This brings us to the most aggressive move IBM made to widen that moat. The balance sheet absorbed a massive hit for the strategic purchase of Confluent, driving the company to a 2.01 times debt-to-equity ratio. The debt-to-equity ratio compares total liabilities to shareholder equity, showing how much debt finances their assets. IBM is aggressively buying up critical market share, but major institutions will ruthlessly scrutinize the coming quarters for integration friction. So, is this spectacular $5.17 billion in cash flow hiding a high-wire balancing act? The verdict is that IBM is executing a brilliant turnaround, but it comes with immense balance sheet friction. The spectacular success of legacy hardware generates the elite cash flow required to finance massive acquisitions and sustain an uncovered dividend. But walking this tightrope with $66.36 billion in total debt means management cannot afford a single misstep. This is a highly leveraged compounding machine demanding close attention. As long as physical infrastructure funds their software ambitions, the current valuation offers a very reasonable margin of safety. But right now, I really want to hear your take. Do you believe this legacy mainframe business can continue funding their massive artificial intelligence ambitions? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.